What's up, investing iguanas? Iggy here with an essential guide for those nearing retirement age. If you're in your 50s or 60s and feeling a bit lost when it comes to financial planning, this video is for you. We'll dive into the key strategies and considerations to help you prepare for a comfortable and secure golden years. From building an emergency fund to navigating the CPF system, legacy planning, healthcare financing, and diversifying your investments, we've got you covered. This topic is research from MoneySense, co-chaired by the Monetary Authority of Singapore with the Ministry of Manpower. So grab a pen and paper, and let's get started on paving the way for your dream retirement. Emergency funds are crucial when dealing with an irregular income. They act as a financial safety net to help you navigate unexpected expenses or periods of reduced income. Ideally, you should aim to have enough savings to cover at least 3 to 6 months' worth of living expenses. However, if your income is particularly unpredictable or irregular, it's wise to have up to 12 months' worth of expenses saved up. This substantial buffer can provide you with the necessary cushion to weather any financial storms or dry spells that life may throw your way. Having a robust emergency fund can give you peace of mind and prevent you from relying on credit cards or loans, which can quickly spiral into debt. It allows you to maintain your financial stability and continue meeting your essential expenses, even when your income takes a temporary dip. Additionally, it can protect you from having to dip into other savings or investments, such as your retirement accounts, which could have long-term consequences. Building an emergency fund takes time and discipline, but it's a worthwhile investment in your financial security. Start by calculating your monthly essential expenses, such as rent or mortgage payments, utilities, groceries, and transportation costs. Then, set a goal to save enough to cover those expenses for the desired number of months. Automate transfers from your checking account to a dedicated savings account, even if it's a small amount initially. Over time, as your income allows, gradually increase the amount you contribute to your emergency fund until you reach your target. The Central Provident Fund, CPF, is a comprehensive social security savings scheme that helps Singaporeans meet their retirement, housing, and healthcare needs. It's a key pillar of the nation's social security system, funded by mandatory contributions from both employers and employees. Under the CPF Life plan, you'll receive a monthly payout for life starting from age 65. This payout is designed to cover your basic living expenses during retirement. You can choose from 3 different CPF Life plans: the basic, full, or enhanced retirement sum, depending on your desired monthly payout amount. Alternatively, you can withdraw up to $5,000 from your CPF savings after age 55, or leave your savings in the account to continue earning interest. The interest rates are attractive, ranging from 2.5% to 6% per annum, depending on your age and account type. However, CPF is more than just a retirement fund. Your CPF savings can also be used for housing purchases, paying for healthcare expenses through MediSave, and funding your children's education. The government also provides top-ups and supplements for lower-income workers to help them build their CPF savings. Overall, the CPF system is designed to provide Singaporeans with a comprehensive safety net for their retirement, housing, and healthcare needs, while also offering flexibility in how the funds can be utilized throughout different life stages. To ensure you have sufficient funds for your desired monthly retirement payout, it's wise to make regular cash top-ups or CPF transfers to your special or retirement account. This proactive approach will help grow your retirement savings over time, thanks to the power of compounding interest. Additionally, you should check if you're eligible for the Matched Retirement Savings Scheme, a government initiative that provides a dollar-for-dollar matching grant on your cash top-ups, up to an annual cap of $600. From 2025 onwards, the annual matching cap will be increased to $2,000, with a lifetime cap of $20,000, making it even more attractive to top up your CPF accounts. However, it's important to note that tax relief for CPF cash top-ups will be removed, as the matching grant itself is already a significant benefit extended by the government. To qualify for the Matched Retirement Savings Scheme, you must be a Singapore citizen aged between 55 and 70 years old. If you meet the eligibility criteria, any cash top-ups you make to your own or your loved one's special or retirement accounts will be matched by the government, effectively doubling your contributions. This scheme not only encourages individuals to save more for their golden years, but also promotes family support in retirement planning. Another strategy to boost your retirement income is to monetize your property. The Silver Housing Bonus Scheme allows you to sell your current HDB flat and purchase a smaller 3-room or smaller unit. By downsizing, you can unlock the cash proceeds from the sale and receive a cash bonus of up to $30,000. This bonus, along with the remaining proceeds, must be topped up into your CPF retirement account to increase your lifelong monthly payouts under the CPF Life plan. If you prefer to remain in your existing flat, the lease buyback scheme is another option. Under this scheme, you can sell part of the remaining lease on your HDB flat back to the Housing and AMP Development Board. The proceeds from selling the lease will be used to top up your retirement account, boosting your monthly CPF Life payouts. Additionally, you will receive a cash bonus, with the amount varying based on your flat type, up to $30,000 for a 3-room flat, $15,000 for a 4-room flat, and $7,500 for a 5-room flat. Both schemes allow you to monetize your home's value without having to move out immediately. By unlocking the equity in your property, you can supplement your retirement income and enjoy a more comfortable lifestyle during your golden years. However, it's crucial to carefully consider your long-term housing needs and weigh the pros and cons before deciding on the best option for your situation. Moving on to legacy planning, it's crucial to have a will in place. A will is a legally binding document that allows you to specify how you want your assets and possessions to be distributed among your beneficiaries after your death. Without a will, the distribution of your estate would be determined by the laws of the state, which may not align with your preferences. Having a clear and valid will can help prevent potential conflicts and disputes among family members, ensuring that your wishes are honored and your loved ones are taken care of according to your intentions. Additionally, a CPF nomination is essential for deciding how your CPF savings will be distributed to your loved ones when you pass on. By making a CPF nomination, you have the flexibility to choose who should receive your CPF savings, and in what proportion. This process is generally quicker and more efficient than having the Public Trustee's Office distribute your CPF savings according to intestacy laws, which can take up to 6 months and incur administrative fees, leaving less for your beneficiaries. It's important to note that a will does not supersede a CPF nomination, so it's crucial to have both in place to ensure that your entire estate, including your CPF savings, is distributed according to your wishes. Furthermore, you may want to consider appointing a trusted individual as your lasting power of attorney, who can make decisions on your behalf should you lose mental capacity. An advanced care plan can also be put in place to outline your preferences for future health and personal care. Let me expand on the lasting power of attorney and advanced care plan in a longer, easy-to-understand paragraph. As you approach your golden years, it's crucial to have a plan in place for situations where you may lose the ability to make decisions for yourself. One important step is appointing a lasting power of attorney, which is a legal document that allows you to voluntarily appoint one or more trusted individuals, called donees, to make decisions on your behalf regarding personal welfare or property and affairs matters. This ensures that if you lose mental capacity one day, your chosen donees can act in your best interests based on your preferences. Additionally, an advanced care plan is a valuable tool that allows you to outline your wishes for future healthcare and personal care, should you become unable to communicate them yourself. This plan involves having open conversations with your loved ones and healthcare providers about your values, beliefs, and goals for care. By documenting your preferences in an advanced care plan, you can ensure that your wishes are respected and your loved ones are empowered to make informed decisions on your behalf, alleviating potential stress and uncertainty during challenging times. Now, let's talk about healthcare financing in more detail. MediShield Life is a national health insurance scheme that covers large hospital bills and costly outpatient treatments like cancer treatments and dialysis. All Singaporeans and permanent residents are automatically covered under this scheme, and the good news is that the premiums can be fully paid using your MediSave account. This means you don't have to worry about out-of-pocket expenses for major medical bills. However, if you prefer to have more flexibility in choosing your own doctor or opt for private hospitals or higher-class wards in public hospitals, your hospital bill would be larger. In such cases, you may want to consider an Integrated Shield Plan, IP. These plans are offered by private insurers and provide additional coverage on top of MediShield Life to help with your out-of-pocket expenses. IPs essentially act as a supplement to MediShield Life, giving you more comprehensive coverage and options. When making a decision to buy an IP, it's important to evaluate your needs and be mindful of the long-term costs that increase significantly with age. While you can use your MediSave to cover IP premiums, there are withdrawal limits. If your IP premium, excluding MediShield Life, exceeds these limits, you may need to pay a portion using cash. It's a good idea to compare the various IP plans offered by different insurers to find the one that best suits your requirements and budget. CareShield Life is a national long-term care insurance scheme designed to provide financial protection against potentially catastrophic long-term care costs. It offers monthly cash payouts to support your basic needs should you develop a severe disability, especially during old age when you may require personal and medical care for an extended period. The scheme covers all Singaporeans and permanent residents, with mandatory participation for those born in 1980 or later. You will be automatically enrolled on October 1, 2020 or when you turn 30, whichever is later, regardless of any pre-existing medical conditions or disabilities. For those born before 1980, participation is optional, but you can choose to join CareShield Life as long as you haven't developed severe disability. One of the key benefits of CareShield Life is the provision of lifetime cash payouts, starting at $600 per month in 2020 and increasing annually until you reach age 67 or make a successful claim, whichever comes first. These payouts continue for as long as you remain unable to perform at least 3 out of 6 activities of daily living, ADLs, such as feeding, dressing, toileting, washing, transferring, and mobility. To make the scheme affordable, the government offers subsidies, and no one will lose coverage due to an inability to pay premiums. Additionally, you can fully pay your CareShield Life premiums using your MediSave account, ensuring that the financial burden is minimized. If you require higher coverage or additional benefits beyond the basic scheme, you can explore CareShield Life supplements offered by private insurers, but be mindful of the long-term costs involved. When it comes to investments, diversification is crucial for managing risks effectively. Instead of putting all your eggs in one basket, it's wise to allocate your funds across different asset classes, industries, and countries. This way, if one investment underperforms, the others can potentially offset those losses, providing a more balanced and stable portfolio. For those seeking lower-risk options, Singapore savings bonds, SSBs, treasury bills, T-bills, and fixed deposits are excellent choices. These investments are capital guaranteed by the Singapore government or banks, ensuring the safety of your principal amount. SSBs, in particular, offer a unique step-up interest rate structure, where the longer you hold the bond, the higher the returns you'll receive. If you're looking to build a more diversified portfolio, exchange-traded funds, ETFs, and unit trusts, UTs, can be great options. These investment vehicles spread your money across various asset classes, industries, and countries, providing exposure to a wide range of opportunities. ETFs and UTs are managed by professional fund managers who aim to maximize returns while managing risks through diversification. However, it's important to remember that higher potential returns often come with higher risks. Before investing in ETFs or UTs, it's crucial to understand your risk appetite and investment horizon. These investments may experience more volatility compared to lower-risk options like SSBs or fixed deposits. That's a wrap, investing iguanas. We've covered a lot of ground today, from emergency funds and CPF to legacy planning, healthcare financing, and investment diversification. Remember, proper financial planning is crucial as you approach retirement. By following these strategies, you can set yourself up for a secure and comfortable future, free from financial worries. Now, I need your help to keep this channel growing. Smash that like button if you found this video helpful, and don't forget to subscribe and hit the notification bell so you never miss an update. Share this video with your friends and family who might also benefit from this financial wisdom, and as always, I'm here to answer your questions and provide personalized advice. Drop your queries in the comments section below, and I'll do my best to address them in future videos. Together, we can work towards achieving our personal visions of financial freedom. Until next time, keep investing, keep learning, and keep striving for prosperity.